Dramatic push-in on stylish suburban exterior at golden hour with cinematic lighting. Choosing a conventional loan can save you thousands, or quietly cost you thousands, depending on credit, down payment, property mortgage insurance, and timing. In the next few minutes, I'll show you how to stack the odds in your favor. If saving money is your goal, subscribe now to Money House Media and smash that like button. Every video protects your budget and builds your equity. Conventional loans aren't government insured like FHA, VA, USDA. They follow agency standards, Fannie Mae, Freddie Mac. Why go conventional? At stronger credit tiers, you often get better rate and property mortgage insurance PMI pricing, plus PMI can be removed later. That's a major savings lever. Two price drivers rule conventional: rate and PMI, both heavily tied to credit score and loan to value, LTV. A 20 to 40 point score bump can shift you into a better bracket. Same house, same down payment. Credit alone can swing property mortgage insurance by $300+ per month and nudge in the rate. That's why we chase the next tier before we lock. Conventional goes as low as 3% down on certain first-time homebuyer or income-eligible programs. 5% is common. 10 to 20% lowers PMI, and at 20% there's no PMI. Trade-off: lower down, JADORs, higher monthly payment, and PMI. Higher down equals lower monthly but more cash up front. Run both scenario, the cash today and monthly tomorrow numbers. PMI protects the lender when loan to value is above 80%. You can structure it several ways. Borrower paid monthly, BPMI, the classic monthly line item. Single premium PMI, 1 upfront fees, eliminate monthly PMI. Use seller credit if available. Split premium PMI, small upfront plus smaller monthly. Great when cash and payment both matter. Lender paid PMI, LPMI. Lender bakes PMI into a slightly higher rate. No monthly PMI line, but compare lifetime cost. Removal path: you can request PMI off around 80% LTV with good payment history. It's automatic near 78% by amortization schedule. Conventional's removability is a huge edge over FHA MIP. Underwriters assess ability to repay, job history. About 2 years helps. But it's not a hard wall. Documented job changes, school, first job, or short gaps can be acceptable. Income types: salary, hourly, bonus, OT, commission, self-employed, each documents differently. Debt to income: front end, housing, plus back end, total debts. Keep total DTI affordable. Reserves: cash in the bank after closing, is helpful but not always required on a primary residence. Even 1-2 months payment savings can strengthen approval and pricing. Takeaway: if you're light on one factor, compensating strengths can balance the file. Nikki and Steve target a $525K home with 5% down, loan $498 out $750. Scores start around 660, good. Their illustrative PMI is $332 a month. They spend 45 days improving their credit. Pay 1 revolving card to 10% utilization, dispute a small error with documentation. Become authorized users on a long, clean trade line, scores rise to 700. Result: PMI requotes near $228 a month. That's $104 a month saved on PMI alone, plus a slightly better rate tier. They also time the lock after the score update and shop a single premium PMI quote. Monthly wins for them, but they confirm the break-even on each option before choosing. Harmony and Chris want a $750K move-up home with 10% down, loan $675K at 90% LTV. Their credit is 740 plus, excellent, clean 2-year work history and 2 months reserves. At 90% LTV, PMI applies, but with 740 plus credit it's low, illustrative monthly $190-210. Strategy: they negotiate a seller's credit to cover single premium PMI at closing. Monthly PMI disappears, payment drops, and they keep cash for reserves and furniture. By structuring PMI this way, they avoid a monthly line item without bumping rate, unlike some LPMI structures. Always compare lifetime cost across BPMI, single premium, split, and LPMI. Rate locks: 30 days, 45 days, and 60 days. Longer locks cost more but provide certainty. Float down: Some lenders allow a one-time reprice if rates drop before closing. Please ask the lender's program. Points: paying upfront for a lower rate. Run the break-even. Time to recover the cost. Temporary buydowns, 2 and 110. Lower initial payments. Verify seller, lender credits, and long-term math. Recast versus refi. After closing, a principal curtailment plus servicer recast can lower principal and interest without a full refinance. If rates fall materially later, refi might be better. Compare costs. Is 3% down always best? Not always. Low cash today can mean higher PMI and payment. Run both paths. Are reserves required? Often, not for primary homes, helpful for stronger approval and/or pricing. Do I need 2 years in the same job? No, 2-year history helps, but documented changes can work. PMI removal timing, request 80% LTV with good history, auto near 78% by schedule. Credit hacks that move tiers fastest? Lower revolving utilization, fix errors, keep on-time streaks, avoid new debt before closing. Follow this and you'll avoid common traps while maximizing savings. If this helped, smash the like button and subscribe for more money-saving mortgage breakdowns. Follow us on Facebook and Instagram, M&M Library. Owning a home is a keystone of wealth, both financial affluence and emotional security. Quote by Susie Orman. Your loan is the tool. Clarity turns it into wealth and stability. This content is for educational purposes only, not financial, legal, or credit advice. Programs, rates, and guidelines change, and every borrower's situation is unique. Always consult licensed professionals. Money House Media, NMLS ID 10020597, all rights reserved.